Hi, we've all heard of Vanguard as one of the best investment platforms that exists to invest in index funds, but there are a couple of pitfalls that are associated with investing in Vanguard, and in this video, I'm going to tell you all about them. Hello and welcome to The Nimble Nomad. My name is Arjun and this is the channel where we talk about the tips, tricks and hacks to survive and thrive in the UK. In case you're new here, please consider subscribing to the channel and giving this video a like. In this video, I'm going to be talking about some of the common pitfalls that are associated with investing in some of the blended funds that are available on Vanguard that you may not be aware of, but you definitely should be aware of. And there's a particular functionality that adds a bit of a cost associated with investing in Vanguard. So the first thing that I want to talk about is the aspect of home bias associated with investing in the life strategy funds. So as you're aware that Vanguard has a multiple swath of index funds that are available to invest in, and one component of that is the life strategy funds. So life strategy funds basically give you access to a predefined basket of funds which include indices from all over the world, and you can have a mix of equity allocation and bond allocation within these life strategy funds, and you can have different percentages of the allocations associated with it. So if you're like me and you want a higher risk exposure and you want a complete equity exposure on your portfolio, then you may choose to invest in the 100% equity life strategy fund. Now what this essentially does is it gives you a home bias. And what I mean specifically by this is if you look at the underlying assets that exist within the life strategy fund, there is a 25% allocation within this blended fund that allocates funds towards the UK stock market. Now that is incredibly high when you consider the global market cap of the UK stock markets in comparison to some of the other stock markets that exist. So that's a higher exposure to the UK stock market. So what would happen is if there was a negative correction or a catastrophic event which was isolated to the UK stock market, your capital would have higher risk exposure to the UK stock market and therefore would be more adversely affected if you were to invest in other funds. Now the best way to mitigate this risk, or if you still want a global diversified exposure, is to probably invest in the Vanguard FTSE All Global Fund. And what that essentially does is it gives you the access to the identical set of funds that the life strategy fund gives, but the allocation to the UK stock market is just 4%. And that's a bit more rationalized from a risk exposure perspective. So the fund, I don't know why they do this within the life strategy fund. My guess is that it has something to do with the base currency, especially if you're a UK resident and you have a UK base account. It's probably to balance out the cost of currency and FX conversions. But my take would be to invest in the global FTSE fund as opposed to the life strategy fund. And that's essentially what I'm doing. I had a look of this and I realized that I already own quite a few individual independent stocks which are UK based. So I wouldn't want that overexposure by investing also again within the 100% equity life strategy fund. So I'm choosing to invest in the FTSE Global Fund, which then reduces my exposure to the UK stock market. Now, the second thing that I want to talk about is the negative and reduced returns that you can get if you were to invest in the life strategy fund, which has a bond allocation in it. So what I specifically am referring to is if you were to choose a 60% or an 80% life strategy fund, 20 or 40% of the portfolio would consist of bonds, depending on what mix you went for. But what essentially happens is you essentially sign up for a specific proportion allocation when you invest in these funds. So let's say you invest £10,000 into the 60% equity life strategy fund. So what essentially you're doing is you're investing £6,000 into the equity markets, and 40% or £4,000 is going into the bonds. Now, if let's say for after 1 year, for the sake of argument, your equity returns a 10% rate of return and becomes £6,600, and your bonds return a 3% rate of return and become £4,120, your allocation mix has changed from that 60%. So now, in essence, you have 61.5% allocated towards equity as opposed to the 60% that you originally signed up for. Now, this is not what you agreed for as your portfolio mix. So what the fund manager would do is he would skim the 1.5% that exists in that 61.5%, and he would reallocate that towards bonds. Now, this actually has a negative effect from a returns perspective, because in essence, you would be buying bonds which actually have a lower rate of return. So if you look right now, the rate of return for a 5-year UK bond is just 0.3%. And for 6 or 7 years, it just goes up marginally by 0.5%. So equities always have a higher risk and a higher rate of return, but bonds necessarily don't have that. And in essence, if you compound this effect over a longer period of time, you're basically reducing your rate of return, and your bond allocation is actually not even beating inflation. So you're getting a negative rate of return, in my opinion. The flip side to this is, if you do want to invest in a 60 or 80% allocation or even lower, what you could do is you could choose to invest independently. So Vanguard provides you the option of investing in bonds. You can choose to choose in a specific single bond fund on Vanguard, and you can independently do it. And if there was a massive market crash, what you could do is you could sell those bond funds, because bond yields usually tend to go up when there's a market crash because investors flock to bonds, and you can reallocate that to equity by buying the dip essentially in the equity market. This is something Warren Buffett says quite frequently. So that's one strategy of adopting. I personally don't invest in bonds because I think that they are yielding a negative rate of return from a comparison to inflation. So that's something I don't personally do, but it is a strategy that you could employ if you want to. Keep in mind, this is not financial advice. This video is just for entertainment. Now, the final point that I want to talk about are the charges that you can incur if you're investing through the Vanguard platform, and these are charges which you could avoid. Now, Vanguard is known for some of the lowest costs in the industry when it comes to investing, in terms of the ongoing platform fees as well as the fund fees that they have, which are really, really dirt cheap compared to the rest of the market. But the thing that you may get caught off with is when you're buying and selling specific funds. If you choose to invest your money, you're usually presented with two options. So option one is to buy using the live price, and there's a second option which is to buy at the next buy option. So basically what Vanguard does is, in order to further reduce their cost, they have this bulk transaction that happens, and the transactions happen at 2 times in the day. So one at 10 a.m. in the morning, and the next at 2 p.m. in the afternoon on each working day when the stock markets are open. So obviously, if you invest through these bulk transactions, the transactions actually are free on the Vanguard platform. So when you buy and sell, you're just buying it in that bulk order and you're getting your transaction free. However, if you choose to select that buy at live price, you're going to end up paying a £10 per transaction fees. So the reason for this is Vanguard is designed to be a long-term investment platform. So they don't want people to be trading the index shares as if they were trading normal stocks. So this is one of the things that people may or may not realize, and they may be transacting on a regular basis. So it's very important that you buy at next live price, because it ensures that it lowers your maintenance and investment costs even further. So those are the 3 things that I wanted to talk about and make people aware of when it comes to investing on the Vanguard platform. If there are things that you think you've struggled with when using Vanguard or investing through Vanguard, I'd love to hear about them in the comments section below. Also, I'm generally seeking a bit of feedback on some of the videos that I'm making. So I'd really appreciate if you can comment in the section below and tell me if there's something that you'd like to see differently, or if there are topics that I'm not necessarily covering that you'd like me to cover going forward in the subsequent videos. That's it for this video, guys, and I will see you next time. Goodbye.